There's this pervasive myth in the tech world that the AI revolution is entirely ethereal.
Right. It's all just code in the cloud.
Exactly. We think of these invisible algorithms just floating in the ether. But if you actually trace the wires back from those, pristine servers, you eventually hit something loud,
Something heavy.
something incredibly industrial. You hit the physical reality of the grid.
And right now, that reality is surprisingly diesel-powered.
We are looking at the fourth quarter and full year 2025 earnings report for Cummins Inc., dated February 5th, 2026. And I think if you see this as just a deep dive into an old school trucking company, you are absolutely missing the real story.
Completely.
This isn't just about moving freight anymore. This report is basically a roadmap of two colliding economies. You've got the massive, slightly recessionary world of physical shipping.
And the explosive, energy-hungry world of AI.
Mm.
It really is a tale of two economies.
I've been digging into these numbers, and what stands out isn't just the raw data, it's the strategic discipline.
Discipline, that's a good word for it. Yeah. You have a 100-plus-year-old engine maker that is somehow the fail-safe for the entire digital age, all while navigating a pretty brutal reality check on the green energy transition.
That reality check is going to be a major focus for us because the numbers there are, well, they're stark.
They are.
But let's start with the headline financials just to set the stage. On the surface, if you just glance at the top line, 2025 looks stagnating.
Stagnating is maybe being generous if you only look at revenue. For the full year, 2025, revenue was $33.7 billion.
Which is actually down.
It's down 1% year over year. Even in the fourth quarter, they barely squeaked out a 1% gain. An algorithm trading on revenue growth would have just skipped right past this.
But that would have been a huge mistake because while the sales were flat, the money they kept, the profit, that tells a completely different story.
A completely different story. Net income in Q4 surged to $593 million.
And what was it the year before?
Just $418 million in the same quarter of 2024. I mean, that is a significant jump in profitability on flat sales.
So, okay, they aren't selling more things, they're selling more profitable things.
Exactly. And this is where we have to peel back the layers. To understand how they pulled this off, you have to ignore the trucks for a moment.
Okay.
You have to look at the power systems segment.
And this is the segment that handles power generation, right? Generators, that kind of thing?
Correct. And this segment is on fire. Sales were up 11% in the fourth quarter. But the real story, the mind-blowing number, is the EBITDA margin.
The operating profitability.
Yes. In power systems, that margin hit 21.7%.
Wow. For a heavy industrial manufacturer, getting over 20% that's significant.
It's elite. A year ago, that same number was around 18%. A 300-plus basis point jump in manufacturing margins is incredibly hard to do just by cutting costs.
So this is a pricing story.
It's all about pricing power. And the driver here is explicitly data centers. The report says, quote, robust demand for data center backup power.
Let's dig into why that demand allows for such high margins. It's not just that people want generators, right?
It's about the cost of failure. I mean, think about the stakes. It's 2026. The AI models being run by, Google, Microsoft, OpenAI, they're consuming gigawatts of power.
Unbelievable amounts.
So if the grid flickers for even a few seconds, the computational loss, the risk of data corruption, we're talking about millions of dollars lost per minute of downtime.
The generator is the insurance policy.
It is the ultimate insurance policy.
Yeah.
And when you're building a $10 billion data center, the price of the generator is a rounding error compared to the risk of going offline. The demand is inelastic.
And they can't say no.
They cannot afford to say no. Cummins has the supply chain, they have the reliability record, so they can basically name their price.
It's just fascinating that the picks and shovels of the AI gold rush aren't just NVIDIA chips. They're also diesel generators. But we said this was a tale of two economies. If the digital side is booming, what's happening with the trucks?
Well, that's the anchor dragging on the ship. The engine segment and the components segment, the traditional heart of Cummins, they were both down. Engine sales dropped 4% in Q4, and components dropped 7%.
That's a pretty sharp contraction. Is that just a Cummins issue?
No, it's the broader market. The North American truck market cooled way off in late 2025. Fleets just weren't buying new rigs. And if you're not buying trucks, you don't need engines, you don't need axles.
It's a classic freight recession signal.
It is. But here's where that resilience theme comes in. Even with their core engine business shrinking, the company still grew total profits.
Because the data center business is so lucrative.
They effectively used the tech boom to subsidize the freight recession.
That's a masterclass in diversification. But there is a third leg to this stool. We've got the booming generators, the struggling engines, and then we have the future.
Ah, yes, Accelera.
We have to talk about Accelera.
This is their zero-emissions brand. This is where the hydrogen fuel cells, the batteries, and the electrolyzers all live. And for the last few years, this has been the darling of all their strategy presentations.
But looking at this report, the tone has shifted dramatically. They took a massive financial hit here.
Hit is, putting it mildly. In the fourth quarter, they recorded a charge of $218 million related to their electrolyzer business.
And for the full year?
For the full year, that charge was $458 million.
Wow. Nearly $500 million in impairment charges. For context, just remind us what an electrolyzer does again.
Sure. An electrolyzer is a machine that uses electricity, hopefully from renewables, to split water into hydrogen and oxygen.
And the idea was to make green hydrogen for trucks.
Exactly. It was supposed to be the holy grail of heavy transport, power trucks and ships with zero carbon emissions.
And clearly that market hasn't materialized.
Not even close. The report is very blunt. It attributes the charge to a strategic review initiated in response to shifts in hydrogen adoption expectations.
Which is corporate speak for.
It's corporate speak for, we thought the market would be here by now, and it simply isn't.
So what are they doing? Are they shutting it all down?
They're pivoting hard. They are stopping all new commercial activity in the electrolyzer space. They'll finish the contracts they have, so they aren't abandoning customers, but they are not chasing new business. They're preserving cash.
This feels like a huge moment, not just for Cummins, but for the whole industry. A market leader is saying the hydrogen economy isn't happening on the timeline we all thought.
It's a massive signal. I mean, the CEO, Jennifer Rumsey, is making a really disciplined choice here. They could have kept pouring that data center profit into the hydrogen pit, hoping the market would turn.
Right, the growth at all costs mentality.
Instead, they're cutting their losses. It's an admission that the infrastructure and the economics for green hydrogen just aren't there yet. It's profitability over promises.
And that $500 million charge must have hurt earnings pretty badly.
Oh, it did. It dragged down their earnings per share significantly. Reported EPS was $20.50 for the year. Without those charges, it would have been $23.78.
That's a 14% hit from one failed bet.
But by cutting it off now, they instantly improved the profitability outlook for 2026.
So this raises a bigger question. If they're pulling back on the sci-fi hydrogen future and the diesel truck market is in a slump, what are they actually building for the next 5 years? They can't just sell the same engines forever.
And this is the part of the report that I think is so clever, but it gets the least attention. They aren't abandoning innovation at all. They're just refocusing it on bridge technologies.
Bridge technologies.
Technologies that work today but are cleaner than yesterday.
This is where that HELM platform comes in.
That's it. HELM. Higher efficiency, lower emissions, multiple fuels. They highlighted the launch of their B7.2 and X10 engines.
And multiple fuels seems like the key phrase there. It sounds like they're hedging their bets.
It is the killer feature. I mean, these are fuel-agnostic platforms. The base engine block, the heavy iron part, is the same, but the head on top where fuel injection happens can be configured to run on diesel, natural gas, or eventually even hydrogen combustion.
So if I'm a trucking company, I don't have to guess what fuel will be the winner in 2030.
You don't have to guess. It de-risks the purchase for the customer. And the X10 engine, specifically, is aimed right at that middle market. Garbage trucks, regional haulers.
The workhorses.
Exactly. It meets the new EPA regulations without forcing a customer into an electric truck they can't charge. It's pragmatic.
There was one other piece of bridge tech in there that caught my eye. The acquisition of assets from a company called First Mode.
Ah, the mining trucks. This is fascinating engineering.
We're talking about those massive haul trucks, right? The size of a house.
Ultra class. They carry hundreds of tons of ore, burn incredible amounts of diesel, and you can't just make them battery electric.
Why not?
The batteries themselves would be so heavy they'd reduce the payload. It just doesn't work.
So what does First Mode do?
They create retrofit hybrid solutions.
Retrofit. So you're not building a whole new truck.
Right. A mining company doesn't want to scrap a $5 million truck that still runs. So Cummins is selling a kit you can bolt onto the existing truck to turn it into a hybrid.
How does that work in a mine?
Think about it. Often the truck drives heavily loaded down into a pit. Gravity does the work.
Right.
The hybrid system uses regenerative braking to capture all that kinetic energy on the way down, stores it, and then uses it to power the truck on the way back up.
So it lowers fuel consumption, cuts carbon, and doesn't require a new vehicle. It's the same philosophy.
It's the same philosophy as the data centers. Meet the customer where the physics and economics actually are, not where we wish they were.
It's just so interesting that innovation for Cummins in 2026 looks less like inventing a new element and more like maximizing efficiency on existing iron.
It's incremental.
Uh-huh.
But at their scale, incremental changes have massive impacts.
So, okay, they've cleaned house in 2025. They've taken the write-downs, launched the new engines. What's the outlook for 2026? Are they expecting this freight recession to end?
The guidance is surprisingly optimistic, actually.
Mm-hmm.
They are projecting full year 2026 revenue to be up 3 to 8%.
Which is a big swing from being down 1% this year.
It's a genuine pivot to growth, and profitability stays strong. They're forecasting EBITDA margins of 17 to 18%.
Where's that growth coming from? Is it just more data centers?
That's a big piece of it. They expect the power system segment to grow another 12 to 17% next year.
Wow. So that boom isn't over.
Not even close. But they also see a turnaround in trucking. The guidance expects North American truck markets to be slightly better, specifically in the second half of 2026.
They're calling the bottom of the cycle.
They're calling the bottom. Trucks wear out. Fleets have been putting off purchases. Eventually, that pendulum has to swing back.
One thing I did notice in the fine print was the tax rate. It looks like that's going up.
Good catch. Yeah, the effective tax rate is projected at about 24% for 2026. It was only 17% a couple years ago. As global minimum tax laws bite, that's just normalizing. But the cash flow still looks very healthy.
And they're sharing that cash. Over $1 billion returned to shareholders in 2025.
And they raised the dividend for the 16th straight year. Which brings us back to the investment thesis. It's a compounder. It prints cash from old industries and strategically reinvests it.
The theme of this entire report really just feels like discipline.
Absolutely. It's a balancing act. They're maximizing the cash cow of diesel and backup power to fund the company, while being incredibly ruthless about cutting the future tech, like electrolyzers. That just isn't working.
It really counters that idea that legacy companies are these dinosaurs that just don't get the future.
They get it just fine. We just aren't willing to lose money on it indefinitely. And that brings me to a thought I've been mulling over since I read this.
Okay.
We often define innovation as building the new thing, the iPhone, the EV, the fuel cell. But what Cummins shows is that real corporate innovation is also about knowing when not to build something.
That is a powerful distinction.
I mean, if a giant like Cummins, with some of the best engineers and deepest pockets in the world, is pressing pause on hydrogen production tech because the market isn't ready, what does that tell us about the realistic timeline for the global energy transition? Are we mistaking press releases and hype for actual demand?
It suggests the bridge to the future might be a lot longer than the optimists think.
A lot longer.
And it might be paved with hybrid diesel engines, not fuel cells.
And powered by backup generators.
Well, on that note, I think I'm going to go check if my portfolio is too heavy on promises and maybe a little too light on profits.
Always a healthy exercise.
That's it for this deep dive into the Cummins 2025 earnings, a masterclass in industrial pivots. Thanks for listening, and we'll see you in the next one.